Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So imagine for a second that you're on your lunch break, right? You pull out your phone, tap a few buttons, and for like the price of a cup of coffee, you instantly purchase a legally binding fraction of a $100 million commercial skyscraper in Manhattan.
Right, just right there from your phone.
Yeah. And I don't mean buying into a massive REIT or some mutual fund. I mean you own a direct digital piece of that specific physical building.
Which is wild to think about.
It really sounds like science fiction. But according to the research we're diving into today, Wall Street is currently rewiring the entire global financial system to let you do exactly that.
Yeah, they really are. I mean, it's an infrastructure overhaul of a scale that we just haven't seen in decades.
And that brings us to the mission for today's deep dive. We are looking at a major buzzword buzzing around Wall Street right now. It's called tokenization.
Right, tokenization.
And our goal today is to cut through all the complex financial jargon and figure out what tokenization actually means for you, the everyday American investor. Especially since, looking at the current U.S. economy under the Trump administration, there's this massive push for deregulation.
Exactly. There's a sweeping focus on modernizing financial efficiency right now. And sitting right at the dead center of that modernization push is this concept of tokenization.
Okay, let's unpack this because tokenization is the buzzword that you literally cannot escape if you read any financial newsletter today.
You really can. It's everywhere.
But for the everyday investor who's just, trying to build a solid retirement portfolio or maybe buy a few shares of a good company, that word can sound super intimidating.
Oh, absolutely. It sounds like intense tech jargon.
Right. I mean, when I hear the word token, my brain immediately defaults to being a kid in an arcade. You trade your cash for a little brass coin to play a video game.
Yeah, the classic Chuck E. Cheese model.
Yeah. Exactly. But obviously, Wall Street isn't playing Pac-Man. So I'm trying to figure out how are those two concepts related, if at all?
Well, the arcade token is actually a surprisingly great starting point, but we have to completely detach from the idea of play money.
Okay, so no actual video games.
Right, no video games. Because the biggest misconception, and data shows this clearly, is that people think tokenization is about creating new imaginary assets out of thin air.
Like inventing fake internet money.
Exactly, and it's not that at all. Tokenization is purely a technological upgrade to how we record the ownership of things that already exist in the real world.
Okay, so it's not a new thing you're buying.
No, it's essentially the process of attaching a digital property tag to a real-world asset, whether that's a share of Apple stock, a U.S. Treasury bond, or, that Manhattan skyscraper you mentioned earlier.
So if I'm understanding this right, it's essentially just an upgrade to the receipt.
That's a really good way to look at it, actually. But to understand the upgrade, you have to look at how that receipt works right now in our current system.
Which is pretty clunky, from what I understand.
Whoa, incredibly clunky. Today, the records of who owns what in the financial markets are kept in these deeply siloed, aging computer systems.
Like old mainframes from the 70s and 80s.
Literally, yes. They are run by a fragmented web of banks, brokerages, and these massive central depositories.
Right.
So what tokenization does is it takes those ownership records out of those private, disconnected vaults and puts them onto a single, transparent digital ledger, a blockchain.
Now, I know our audience is somewhat familiar with the broad strokes of blockchain, but in traditional media, you often hear it described as just a giant, unhackable spreadsheet.
Which is a bit of a dangerous simplification.
Yeah, that feels a bit overly simplistic, especially when we were talking about moving trillions of dollars of global wealth onto it. You can't just call it unhackable and call it a day.
No, you really can't. Calling anything unhackable in finance is just asking for trouble. A more accurate way to understand it is through the concept of distributed consensus.
Distributed consensus. Break that down for me.
Sure, so instead of relying on one central authority, like a single bank's private server to tell everyone who owns what, a blockchain uses a vast network of computers.
Okay.
And all these computers constantly cross-check and verify the ledger against each other. They have to reach a consensus.
So if one computer gets hacked, the others catch the error.
Exactly. If someone tries to maliciously alter a record, the rest of the network just rejects it.
Oh, I see.
So tokenization means taking a real asset, dividing it up and managing its ownership on this distributed, unified network, rather than bouncing between legacy middlemen.
I read an analogy in the research for today's deep dive that I think really helps visualize this. It compared this whole shift to the evolution of concert tickets.
Oh, that's a great comparison.
Right, because back in the day, you bought a physical paper ticket. You had to keep it safe in your wallet.
And you lived in fear of putting it through the washing machine.
Exactly. And if you wanted to sell it to a friend, you had to physically meet up and hand them the paper ticket. But today, you have a mobile QR code on your phone.
Right.
The concert hasn't changed. The band is the same. The venue is the same. Your specific seat is the same. Only the method of holding and transferring the ticket has totally upgraded to digital. Is that essentially what we are doing to stocks and bonds?
Yes. What's fascinating here is that the concert ticket analogy gets you about halfway there, but it actually breaks down in one crucial area.
Oh. Where does it break down?
Well, with a digital concert ticket, you are still entirely reliant on a central authority, like, say, Ticketmaster.
Right. You need their app to work.
Exactly. You rely on them to issue the QR code, maintain the server, and scan it at the door. If the server goes down, nobody gets into the concert.
Which definitely happens.
It does. But tokenization via blockchain removes that central point of failure. The network itself is the verifier, not one single company.
Got it. So it's a ticket that verifies itself without needing the ticket company.
Basically, yeah. But the underlying premise of your analogy holds completely true. The asset itself hasn't changed. A U.S. Treasury bond token is still just government debt. It's just packaged for a modern digital highway.
Okay, that makes the what's very clear. But let's move on and dig into the why. Because ripping out all this old plumbing of Wall Street and replacing it with blockchain networks sounds incredibly expensive.
Oh, it's a massive multi-billion-dollar undertaking.
Right, and chaotic. So why are massive institutions pushing for this? If the current system basically works, why go through the effort of fixing it?
Because behind the scenes, according to recent analysis, the current system is actually remarkably fragile and incredibly slow.
Slow, but when I buy a stock on my app, it shows up instantly.
Right, you get the illusion of speed. When you click buy on your brokerage app, the stock showed up in your portfolio interface immediately. But that is literally just a front-end interface trick.
Wait, really? It's just a trick.
Yeah, the actual settlement, the moment the money officially leaves your bank and the legal ownership of the stock officially transfers to you, that takes time.
How much time are we talking?
Historically, this has been the T+2 settlement cycle, meaning the trade date plus 2 full business days.
Right, and I know there's been a recent push to shorten that to T+1, but still, that's fundamentally a delayed process.
Exactly. You're still waiting at least a day.
But why does it take days to move data in the 21st century? I mean, I can send an email across the world in half a second.
Because it's not just data.
Yeah.
It's legal verification passing through a long chain of middlemen.
Middleman, always the middleman.
Exactly. Your broker has to talk to a clearinghouse. The clearinghouse talks to a depository. The depository talks to the seller's broker.
That sounds exhausting.
It is. At every single stop along that chain, the transaction has to be manually reconciled. Middlemen take a tiny cut of the fee, and each step introduces a slight risk of failure.
So where does tokenization come in? Does it just speed up the middleman?
No, tokenization completely collapses that chain. It removes them entirely.
How exactly? Because if the middlemen are gone, who is doing the reconciling? Who is making sure I actually have the money to buy the stock?
This brings us to the actual mechanism that makes tokenization work, which is called smart contracts.
Smart contracts. Okay, what are those?
Think of a smart contract like a digital vending machine.
Okay.
A physical vending machine doesn't need a clerk standing there to facilitate the transaction.
Right, you just put your money in.
Exactly.
Yeah.
The machine is programmed with logic. If you insert a dollar and press A4, the machine verifies the money and drops the soda at the exact same time.
That makes sense.
A smart contract is just self-executing code on the blockchain that acts like that vending machine. It acts as an automatic escrow.
Oh, wow. So the code holds the buyer's money and the seller's asset at the same time.
You nailed it. It's called atomic settlement. The code ensures that the money and the tokenized asset swap hands at the exact same millisecond.
And if someone is trying to cheat the system,
If either party doesn't have the funds or the asset, the transaction simply fails. Instantly. There is no waiting period, no reconciliation error, and no chain of brokers skimming fractions of a penny off the top.
okay, that sounds incredibly efficient.
Yeah.
But here's where it gets really interesting for the average person.
Right.
Because we have to talk about fractionalization.
Yes. Fractionalization is massive. That is where tokenization moves from just being a back office efficiency to an actual consumer-facing revolution.
Right. Because it fundamentally democratizes access. Let's go back to that real estate analogy from the source data. And what about the skyscraper?
The $100 million building.
Yeah. Historically, if you wanted exposure to premium commercial real estate like that, you either needed millions of dollars or you had to buy into a broad REIT where you don't actually pick the specific building.
Exactly. It was basically a gated community for ultra-high net worth individuals and massive pension funds. Regular people couldn't buy in.
Right. But with this, instead of needing millions of dollars to buy a skyscraper, you could potentially buy one digital brick of it for a few bucks.
Exactly. If the owners of that skyscraper tokenize it, they can divide the equity of that single building into, say, 10 million digital tokens on a blockchain.
And each token is a real piece of the building.
Yes, each token represents a tiny, legally enforceable fraction of the real estate. And maybe it costs $10. So you, as a regular investor, can curate your own custom real estate portfolio brick by brick.
Okay, so this is the point where I know half of our listeners are mentally hitting the brakes.
Oh, I can guess why?
Yeah, because the moment we start talking about buying digital tokens for $10, the average American beginner investor immediately thinks of cryptocurrency.
They think of Bitcoin.
Exactly.
Yeah.
They think of Bitcoin, they think of volatile meme coins, Dogecoin, massive market swings. So we need to clearly define the boundary here.
That is extremely important to do.
To put it simply, why is buying a tokenized skyscraper different from buying Bitcoin? Are we just talking about crypto here?
It's the most common point of confusion, but they are entirely different beasts. To keep it incredibly simple, Bitcoin is an asset that was born digital.
Born digital, meaning it doesn't exist anywhere else.
Right. It has value because a global network of people agree it has value, but it has no physical counterpart in the real world.
So if the internet turns off forever, Bitcoin is just gone.
Exactly. If the power grid goes down permanently, Bitcoin ceases to exist. Tokenization, however, takes existing real-world assets and translates them into a digital form.
I think I've got an analogy for this.
Yeah.
So to put it simply, Bitcoin is like a completely new virtual video game world created from scratch.
Yeah, I like that.
Whereas tokenization is just taking a real physical map of New York City
Yeah.
and digitizing it for your GPS.
Yes, that is exactly right. Tokenization is like a digital property deed to your actual physical house. The token represents the deed, but the house is made of wood and concrete.
It exists regardless of whether the internet is turned on.
Precisely. You are not inventing a new meme coin. You are making Wall Street's traditional, highly regulated assets move much more efficiently.
So a tokenized U.S. Treasury is just a U.S. Treasury. I'm not buying a Treasury-themed crypto coin. I am buying the literal debt of the United States government.
Exactly right. You are taking on the risk of the U.S. government or the risk of that specific piece of Manhattan real estate. You are not taking on the speculative risk of a crypto network.
Okay, that distinction is crucial. It really grounds the conversation. But look, this is a deep dive. We can't just read the marketing brochures and call it a day.
No, we have to look at the downside.
Exactly. We have to look to the structural flaws. Because whenever you take an infrastructure that has been running a certain way for nearly a century and you completely strip away the friction, things break.
They absolutely do.
We talked about all these amazing benefits, but what are the actual dangers of tokenizing real-world assets? What's the catch?
The data indicates there are two massive systemic risks here. And the first one is purely legal.
Legal risk. How so?
Well, we've been saying that a tokenized share of a company is the exact same as a regular share. But the pressing question right now is, does a bankruptcy judge agree with that?
Wait, what do you mean? If I own the token, I own the asset. The blockchain says so.
Not necessarily in the eyes of the law. You have to look at how the asset is tokenized.
Right.
There is what we call native tokenization, where a company legally issues its stock directly on the blockchain under corporate law. That's pretty safe.
But I'm guessing that's not what usually happens.
Right. What is much more common right now is wrapped tokenization.
Wrapped tokenization.
Yeah. This is where a third-party company buys traditional stock, puts it into a special purpose vehicle like a legal trust, and then issues digital tokens that just represent the shares sitting in that trust.
Wait, seriously? So I'm just buying a representation of a share?
Yeah.
That introduces a massive counterparty risk.
Exactly. You don't actually own the underlying stock. You own a digital receipt from a third-party trust.
Oh, wow.
So if that third-party trust gets sued, or goes bankrupt or gets mismanaged, your token might suddenly become worthless, even if the underlying company you thought you were investing in is doing perfectly fine.
That is a staggering realization.
It is. The legal frameworks in the United States are still catching up. If push comes to shove in a courtroom, you might find out that your token is legally viewed as a synthetic derivative, not actual equity.
So you might not have voting rights, and you might be at the very back of the line in bankruptcy court.
Exactly. The blockchain might mathematically prove that you own the token, but technology cannot bypass the legal system. The blockchain can't force a real-world judge to respect it.
You really have to be hyper-vigilant about the legal structure binding the token to the real-world asset.
You do. You can't just blindly trust the tech.
Okay, so that is a profound legal risk.
Right.
But what about the operational risk? We talked earlier about moving to instant settlement and 2047 trading.
Right. The system never sleeping.
Exactly. Yeah. Wall Street never sleeps, literally. Now, it sounds incredibly efficient, but so what does this all mean? If the market crashes at 2 a.m. on a Sunday, there's no closing bell to stop the bleeding. Are we removing the brakes from a very fast car?
We are. And that is the second major risk highlighted in the analysis. Systemic fragility.
Systemic fragility.
Yeah, think about it. Traditional financial markets have built-in shock absorbers. The stock market closes at 4 p.m. It closes on weekends. It closes on holidays.
Which gives everyone a chance to breathe.
Exactly. If catastrophic global news breaks on a Saturday morning, the market has 2 full days to digest the information. Analysts can run models, investors can calm down, and cooler heads can prevail before Monday morning.
But in a fully tokenized, global, blockchain-based market, there is literally no closing bell.
Right. If terrible news breaks at 2 a.m. on a Sunday, a global panic can trigger an immediate, instantaneous sell-off.
Oh, man, and algorithms would just take over.
Exactly. Algorithms start dumping assets, triggering margin calls, which triggers more algorithms to sell. You could see a multi-trillion-dollar flash crash happen while the American public is literally asleep in their beds.
Wow. I mean, we saw a version of that with the famous flash crash in traditional equities a while back, but that was somewhat contained by market rules.
Right, because of those natural friction points.
It's funny, we complain about the delays, the T+2 settlement, the weekend closures when we want to buy something quickly, but those delays actually act as circuit breakers.
They do. They prevent a contained fire from burning down the entire forest. This raises an important question, actually.
What's that?
It's not about whether tokenization is inherently good or bad. It's about what rules, regulations, and safety nets are built into this new digital system.
Right.
If we are upgrading the plumbing to allow water to flow at 1,000,000 miles an hour, we have to build in pressure valves, or the pipes will burst.
That makes total sense. We might need to encode artificial circuit breakers directly into the smart contracts, like halting trading if an asset drops 20% in an hour, just to simulate the breathing room we used to get from a weekend.
Exactly. We have to design the safety rails before we launch the train.
That is such a vital perspective.
Okay.
As we start to wrap this up, I want to summarize the core takeaway for the listener, using a historical parallel from the research, which I just found incredibly clarifying.
Are you talking about the email analogy?
Yes, the email analogy.
That's a great one.
It really is. Think about it. Before the internet, if you wanted to send a business contract across the country, you wrote it on paper, put a physical stamp on it, and handed it to a mail carrier.
And it took 3 days to get there.
Right. It went through sorting facilities, it cost postage. Then email was invented. Now, email didn't eliminate the concept of writing letters or making business agreements. People still needed to make contracts. It just completely revolutionized the infrastructure of how that information traveled. It made it instant, nearly free, and borderless.
It's a perfect parallel. Tokenization doesn't eliminate assets. It just changes how they travel. A good company is still a good company. A bad real estate deal is still a bad real estate deal.
Exactly.
The asset remains exactly what it is. We are simply upgrading the infrastructure of ownership from analog ledgers to digital programmable networks.
And as we stand on the edge of that upgrade, the changes aren't just going to be technological. As we've seen today, it's going to change who gets to invest, how fast we invest, and the real legal risks we take on.
It definitely will. And, it also leaves us with a profound psychological question to mull over.
Oh, go for it. Leave us with a final thought.
Well, think about this. If everything in the world, from a slice of a commercial skyscraper to a U.S. Treasury bond to a piece of fine art, becomes a digital token that can be instantly traded 24/7 on your phone, how does that change our psychology as investors?
That's a really good question.
Will we stop seeing assets for what they physically are? Like, do we stop seeing a building as a physical place where businesses operate and people work, and only see it as a flashing red or green number on a screen? Hyper-financializing, literally everything has to have consequences for how we value the physical world.
Wow. That is an incredible thought to chew on. When everything becomes a perfectly liquid token, the world essentially becomes one giant, non-stop trading floor, for better or worse.
Exactly.
Well, technology solves the speed limit, but human nature is always the wild card. Thank you all for joining us on this deep dive into the mechanics of our changing financial system. Don't forget to subscribe and hit that like button.